É com grande honra que convido Nicolas Balha, Managing Director Valuation Services na Crow, para fazer a abertura do nosso terceiro painel, que tratará sobre due diligence e avaliação de novas fronteiras de ativos, criptofundos. E já convidar os nossos debatedores para estarem aqui à frente, José Arthur Ribeiro, CEO na Coinex, Nicolas Satti, Head of Research Digital Assets no BTG Pactual, e John Ward, Managing Director Valuation Services na Crow.
Boa tarde. Então, só uma pequena introdução em português. Já vou agradecer a vocês, porque a gente vai fazer o painel em inglês. Para mim, não muda nada. Eu sou francês, então o meu sotaque é ruim, mesmo todas as línguas do mundo. Então, thank you very much for being with us today. And I will start right away with Nicholas. So, Nicholas,
Hi.
Can you briefly explain what blockchain means and how it is connected to digital assets and crypto?
Sure. First, I would like to ask the audience who here knows what blockchain is, just to see. Okay, so blockchain is a technology that was massively adopted with Bitcoin, but it was created in the 90s. And actually, it is a system for all sorts of decentralized registries. And decentralized means that you don't need a central authority to make the registration of transactions, informations, and all sorts of stuff, right? So it connects to crypto because it is the underlying technology for the crypto registries. And Bitcoin started with it, and you have different types of players within this industry, and one of them are the miners, who are responsible for the registries, and actually the miners also are the ones responsible for creating and issuing new Bitcoins or new cryptocurrencies as a whole.
Thank you. John, so now that we know how it works, can you discuss the types of trading strategies that fund managers are using today, and how does that compare to what you were seeing from fund managers a few years ago?
Thank you. So I started doing due diligence on crypto managers 2017, so about almost 6 years ago. And at that time, really the only choice that an investment manager had was to buy a particular asset or sell the particular asset. And sort of like a mutual fund, you only had one choice, which was to go long or to be exposed to a particular security. In 2017, 18, and into 2019, as we were talking earlier today, it was strategies long-short, or long-only, actually, long-only. There were some arbitrage strategies where Bitcoin was trading at one price on one exchange and a slightly different price on a different exchange, and people would buy and sell between the exchanges to make the arbitrage profit. Over the last few years, the industry has matured, and through DeFi, which we'll talk about in a little bit later, managers can now do more mature investments. So now you can see long-short because there is ability to go short through borrowing a security and selling it short so that you can get downside protection. You now can have a hedged strategy. We're still seeing quantitative strategies, in other words, computer-based trading. We're seeing high-frequency trading, managers that are doing thousands or tens of thousands of trades per day by computer. We are seeing non-directional. In other words, managers who are not worried whether a particular coin or index goes up or down. They're just trying to make volatility trades in the market and make profits. You still see long only. On the illiquid side, so the miners, venture capital, early stage, there are closed-end funds like a venture capital fund or a private equity fund that are doing early stage investments in a more locked up, closed-end fund vehicle. They will invest in miners, they will invest in exchanges, they will invest in new blockchain ideas. So there is venture capital-like investment or private equity investment and hedge fund investment And somewhere, hopefully in the next year or so, some of the regulators will open up and you will get true public indexes or ETFs or mutual funds. Right now, there is none of that allowed in the more mature market. So in the US and Europe, there are no mutual funds, there are no ETFs or closed-end funds that are publicly traded that public investors can get into.
Nicholas, John just talked about DeFi. What is it? And how is it impacting crypto funds?
So I guess if you guys don't know what is blockchain, I guess you also don't know what DeFi is as well. Am I right? Okay, so DeFi is short for decentralized finance, and depends on which time frame and which type of market you consider. But in my opinion, the first DeFi application, it was Bitcoin itself, because it was the first type of decentralized finance application created using the blockchain technology. But in the industry, DeFi means any type of application that is related to finance and cut intermediaries using smart contracts. Smart contracts are pieces of code that runs inside blockchains, and you can make every sort of application with it. So think in everything related to finance, borrow, lending, derivatives, trading, everything that you can do with traditional finance, now you can do as well with automated smart contracts, automated systems, right? And actually in a much more efficient way and in a much more transparent way for auditors and stuff like that to see what is happening inside of these platforms.
If I could add a little more, if you are running a traditional hedge fund or mutual fund today, buying stocks and bonds, you probably have a banking relationship or a prime brokerage relationship with one of the big global banks that allows you to borrow shares, leverage. You can do complex things like derivatives and swaps, options, OTC transactions, block trades, those types of transactions which are traditional. As I said, in 2015, 16, 17, 18, that didn't exist. DeFi was the new way of saying we don't need an investment bank to do it. Let's do it ourselves within the blockchain community. So how do we borrow coins from one person to the next to allow you to short? How do I put on a swap transaction? How do I do other types of derivative transactions? And how do I get leverage? What am I posting, collateral? And those types of questions were all brought to the market, and DeFi solutions, decentralized finance, said we don't need banks. Let's create our own way to do this. What are the pros and the cons? Big banks obviously offer security. So if I'm doing a transaction with a Goldman Sachs, a Bank of America, Citigroup, up until 2008, we were not worried about them failing. Obviously, 2008 caused a lot of people to rethink the safety of banks. But putting that aside, the bank acted as an intermediary. I borrowed from the bank lent me the shares, I did what I did. They got the shares from him. But if I failed, I did something wrong, I blew up, his shares were still safe because Goldman Sachs was in the middle of the transaction, and he could go back to Goldman Sachs and said, make me whole. It's not my fault that you lent the shares out to somebody else who did bad things with them. He had Goldman Sachs between the two of us, or Citigroup between the two of us. So one of the things that DeFi had to come over is that person-to-person risk. How do we do that? And certain exchanges and platforms were created so I can deposit my coins onto an exchange, and they lend my coins to him. And so we went around a bank and created exchanges and platforms and DeFi counterparties, and on and on and on. So DeFi, some people jokingly call it a sort of a hedge fund 2.0 in the crypto space, or crypto 2.0, which was the maturity of products available to the marketplace so that asset managers can put on well thought out investments and trades using exchanges, platforms, smart contracts, DAOs, and we'll talk about some of that a little bit more. But so it's the maturity of the marketplace into modern professional management that we're talking about.
Okay. Oh, sorry.
No. Also with DeFi, given that the blockchain is a more efficient way to manage capital, you have some innovations that you could not do with traditional finance, given that even though you have an electronic money system for years now, you don't have a digital system that is the base for the monetary system, still mirroring what it was happening with the paper money, paper currency. So with digital payments and digital smart contracts, you can now make programmable money. So in a single transaction, you can make, you can borrow money, you can make a arbitrage operation, then you can obtain a profit from that arbitrage operation and give back the money from the lender to the lender. Everything in a single transaction made in 2 seconds. It's what we call flash loans. So we have some sort of innovation happening in this environment that will shape the future of finance as we know it. Yeah.
Okay. So if I'm not mistaken, because I'm like you, I don't understand blockchain or DeFi. Everything they've talked about, we already have coins and we already have crypto assets. But at some point before that, we need to bring our normal money to the world of crypto. And I think that's where an exchange comes in, CoinNext, where you bring your fiat, what they call money, and in exchange of that fiat money, you get your first Bitcoin. Right?
Yeah, we are the bridge between the...
And so that's my first question to you, José Arturo. What are some of the key risks an investor face when considering investing in crypto?
That's a good one. I would say there are 3 major risks that investors should consider. The first one would be, I guess you guys also agree, is custody. I mean, having your custody of your own digital assets is critical. It's something really critical. It's something from an exchange, the exchange perspective, that was something that made me sleep very badly, I would say. So, I mean, now we, as an exchange, we have tried to solve that through BitGo. BitGo is an example of a regular a custodian, a formal custodian, which is regulated by the SEC in the US. So as far as I know, we are the only one in Brazil who has this kind of regulated custodian partnership. So 90%, 93% of our digital assets are under the cold storage of the BitGo. In the UX of the custody of digital assets is not good, right? You need to understand about like private keys, public keys, and you have to know how to keep your own keys. So it's tough.
And just to put everyone on the same page here, custody is critical because every single transaction you made in a blockchain is irreversible. So you don't have somebody from the bank you can call and say, oh, please, can I have my Bitcoin back? No, that's not an option, because once the transaction has been made in the blockchain, it can never go back. So custody is critical, and it's exchanges are a big pot of gold, right?
Yeah.
For hackers and other players, yeah.
Exactly. So
And it settles cash. A trade, a regular stock trade, takes a day or 2 or 3 to settle. On a transaction done in digital assets has to be paid for at the time of the transaction. Like when you buy something at the store, forget about credit cards. But if you were buying something in the store, you have to pay cash and you get your product that you just purchased. That's sort of how digital assets. So the only way you could sell something, if you had 1 Bitcoin and you wanted to sell it now, it has to be at the exchange now for you to sell it now. You can't say, I promise I'll deliver my Bitcoin 2 days from now. No, if you want to sell it now, it has to be there now. And that's why I would hand the Bitcoin to Coinext and say, I want to sell it. But I run the risk if I say, I may want to sell it. Let me put it on the exchange and think about it. While it's sitting on an exchange that is poorly run, that does not have good security, it could get stolen. So I would want to look to an exchange like Coinext that gives good security. So while I'm thinking about maybe selling it, I could deposit and feel safe that if I trade it 2 days from now, it's not going to get stolen during those 2 days while I'm thinking.
Yeah, and the second risk I would say is maybe exactly the one that John is saying is related to the counterparty, right? I mean the counterparty risk. So you must know which institution, which business, which company is dealing with your crypto, with your money. So that's something very critical as well. So you definitely need to trust if the solvency situation of that business is okay, right? And if you are not able to do your own custody, if you let the crypto assets under the custody of this counterparty, you must analyze and see if it's regular or not. I mean, and you know, and it's not difficult. I mean, in Brazil we have Reclame Aqui, we have some sources of information. You get to know that if that counterparty is a legal entity based in Brazil, for instance, so if there is a CNPJ, etc. So there's some ways to verify the counterparty if that's trustable or not. And the third one, I would say, is the third critical major risk of having and dealing with crypto is the volatility. Of course, we are talking about a very volatile asset, and usually people buy the assets, and Brazilian, they love buying at the all-time high prices of the assets. So we usually say that the people like to buy at the top and sell in the bottom.
Buy high and sell low, right?
And sell low. So, and that's something that the investor must know, that the crypto is really high volatility asset, and so it should take care of the percentage of the assets you are allocating, or the resource you are allocating into crypto. We usually say 5% of your portfolio is already, too aggressive in terms of investment, but some people have like 30, 40%, like myself. But anyway, and that's. But I mean, for someone who are not involved in that business, they should take a little careful into the volatility aspect.
Yeah, I would actually add a fourth major risk that is related to regulation. And I believe that this is one of the major risks because the code itself is well done for Bitcoin and other crypto assets. But if the pain is too harsh on the sector, you can make the on-ramps and off-ramps platforms out of services. You can make the custody solutions perish. So there is a critical and important role of governments and regulators with the evolving side of this industry. And I believe that in most of the countries worldwide, we are seeing a good regulation that fosters innovation. I don't know if you agree, John?
Some are better than others.
Yeah, some are better than others. China is a bad example because they are issuing their own central bank digital currency. Yeah, yeah, but they don't want competitors, right? Because they have a history of controlling their population, and money is a type of control.
And along with one of the complicating things is not just regulation, but taxation. So a lot of governments around the world want to know that if you buy a Bitcoin for $10,000 and sell it for $20,000, they want to tax that profit. The tax man comes to find you. Some countries say there's no taxes on capital gains, like Singapore. Other countries, like the United States, they treat Bitcoin not like a security. So if you're an American and you buy and sell stocks, at the end of the year, you sort of add up all your pluses and your minuses, and then you say, at the end of the year, I made a certain amount of money, and you declare that. The digital asset in the United States is treated as a fixed asset, like you buying a car or buying a house. So you declare, I bought it, and I declare that I sold it. If I made money, I pay taxes. If I lose money, too bad. You can't write off the losses. What is that? Why is that difficult? Think about a fund that buy, sell, buy, sell, buy, sell, buy, sell. Soon your transactions are massive to report. You can't just net them out. You have to keep track of every transaction. It also becomes a difficulty if you want to use Bitcoin like money and go to a store and buy your dinner for $100. Well, what was the cost basis of that $100? You just spent $100 equivalent of Bitcoin, but when did you buy it? So every time you use Bitcoin to buy a Tesla or some other product in the United States, it's now a taxable event. So not only did it cost you $100 to buy the dinner, it might have cost you another $10 or $20 in taxes that you have to pay to the government for cashing in your Bitcoin. So taxation is driving people and how they structure their funds, where they structure their funds, and it's making the world very complicated because of global tax rules, global regulatory rules, and we're finding out managers are putting their funds in sometimes not friendly countries just to avoid taxes. And as a potential investor in that fund, you have to be aware, well, what are the rules of Mauritius? What are the rules of Gibraltar? What are the rules of different countries? And before you consider investing in that fund, you have to understand the tax schemes in those countries.
And John, in Brazil, we have something that we say that there are two certainties in life. The first one is death. You're going to die. The second one is going to pay taxes, right? And
they'll try to tax you even after you're dead.
Exactly. But in that specific point, Brazil was a tremendous advance in terms of taxation. And actually, Brazil was probably the first one to regulate first taxes. And then we are discussing now with the Brazilian Congress how to manage the other things. But we are very well in digitalized taxation processes of collection, etc. But in 2019, we have the Brazilian tax authority have developed mandatory requirement that us as exchange we need to every month we need to report every single transaction, every single buy and sell of personal entity in Brazil is being reported to the tax authority. So if you take like central bank, the security exchange, the Brazilian Security Exchange Commission, and the tax authority was the first one and did an incredible. It's really good and well done tool to report for us to report the transactions just for.
Yeah. So about regulation, a few weeks ago I heard the CEO of Binance saying that France had one of the most friendly regulations on crypto in the world. I had never heard France having a friendly regulation on anything, so I was really surprised. But anyway, then we can maybe discuss this later. So now, guys, you had reais, and I think you understood how to get Bitcoin and to get into the world of having a crypto asset. And my next question is for John with a follow-up question to José Artur. So now that we have a crypto asset, let's say we are a fund. Where do crypto funds trade, and how do they trade? Okay.
I'll keep it very simple and basic. How they trade is either by computer, as we talked about, using computers to trade fast, or you can program a computer, or point and click, which is essentially it's all being done on computer using your mouse, and you say buy here and sell there. It is done by humans or by machines. the hedge fund or the fund manager has his own strategy, what they hope to do, and they discuss their strategy. So one of the largest funds launched this spring in out of London. The firm Brevin Howard launched a very big multi-strategy fund. What is their strategy? They have 3 strategies. If you put in $100, they break it up a third, a third, a third into the 3 strategies. One strategy is venture, so it's a long term. Your money's locked up with Brevin Howard for 11 years. The second strategy is non-directional, meaning that they are going to trade in the markets. They're not going to be saying it's going to go up, so we're investing. They're just going to say we will be fast and fluid. The third one is directional, that they're looking at what are the long-term, doing the research on long-term investments. So that as a manager comes out and says, this is what we're doing. So one is sort of like venture capital investment banking. One is high-frequency trading and other market-neutral strategies, and one is directional. So they come out and tell you how they're doing it. Globally, we are seeing managers in Cayman that are being set up in Cayman, and the BVIs, like is typical, very common. We're also seeing managers, of course, in the US. I've been on site with managers in Australia, New Zealand, Spain, Switzerland, London, the US. I hope to meet some managers while I'm down here. I've been in with managers in Mexico, Singapore, China, Hong Kong, Malaysia, and Taiwan. I've been on site with managers in all those countries trying to understand what they do. And because of regulations, one of the managers I looked at, the head guy is in Puerto Rico. He's in Puerto Rico because of taxes. He left the United States, he moved his family to Puerto Rico. The head trader is in Shenzhen, but is trading out of Singapore because Singapore has got low taxes. But Singapore will tax you if you're trading there on the capital gains. So actually they have an office in Singapore, but no one's in it. And they put it there just for the sake of taxes. The people are trading out of Shanghai, Shenzhen, and Beijing for the fund, and then they have people in Switzerland and California. So that is a very common practice that you have people around the world because crypto trades 24 hours a day, 7 days a week. And they put funds in Mauritius. As I said, BVIs, we see them in Guernsey, we see them in Switzerland. DACM is in Australia. So there's all kinds of, the managers are located anywhere that you can think of, as far as I know, and obviously in Central and South America as well.
Yeah, and that shows that why it is so hard to regulate the crypto industry, right? Because it is a borderless technology. And because of that, it falls under multiple jurisdictions. And you don't have a single authority that regulates the crypto environment worldwide. So you see often players within this industry making regulatory arbitrage and moving to places that are more attractive to their gains, right?
Yeah.
From a tax perspective, yeah. It's like internet, right? I mean, internet, there's no like CEO or government who owns the internet, right? And crypto is decentralized like internet-based technology.
And my follow-up questions were to you, José Arturo. Is all crypto trading being done on exchange like CoinEx or platform, or not? And because you were the founder of CoinEx, what are the main challenges for a CEO of a crypto exchange business in Brazil, especially?
Okay, I mean, if you take the crypto as itself, I mean, it shouldn't be, you shouldn't have like an intermediary to do any kind of transactions. Like crypto should be peer-to-peer, but it's not really possible because, I mean, I don't trust really well in Alexandre, for example. So if he has the amount that I want to buy, or the amount, specific amount that I need to, I mean, I need to sell, and he wants to buy. So usually people use an exchange because it's a trustable counterparty where you put your money to buy some crypto that someone is really selling, and etc. So it's a good user experience, right? But no, not all the transactions are made through exchange. There's some peer-to-peer transactions also, and agents who does it. I would say that's a little bit, at least at my experience in Brazil, it's a little bit underground transactions. It's not reported, or but anyway, you can do it through with another person.
It's a little like eBay.
Peer-to-peer.
If you owned something that you wanted to sell on eBay, you can find the other side of the trade. If you owned, I don't know, an antique, what would you do before eBay existed? You would maybe put an ad in the paper, or you would talk to your neighbors. How many of you would walk around and say, do any of you want to buy any Bitcoin? The only way that's not realistic. You're not going to put an ad in the paper. You go to an exchange because you own Bitcoin and you want to sell it. You want to get fast, easy liquidity. You want to trust that it's going to get done. The price is very transparent. It's not like you have to negotiate it like you're selling a car. The price is right there, and it's done.
Yeah. And I would say, I mean, you asked also about like the
challenges,
challenges
yes,
of
okay.
having a crypto exchange in Brazil, right? Well, I would be here like the whole afternoon, but and could not finish. But I would say the main items I would say is the first one is something that Nicolas said very well, which is really regarding to the regulation. I mean, Brazil is always a question mark in that regard. So we never know what the authorities are going to think about and will consider and approve at the Congress perspective. But also, I would say the first one is people. And that's not for cryptocurrency exchange, it's for tech industry in general. But finding the right people to work with yourself, developers who understand about blockchain, for instance, is something really rare in the market to find. And third one would be custody. I mean, that was security, managing security.
How about competing with players that are in other jurisdictions?
Well, I don't see that. I mean, it depends on your DNA. We were born to be a Brazilian exchange, a Brazilian crypto exchange, doing like fiat to crypto, and doing that kind of bridge from the real world to the digital currency world. So we are used with that type of users and clients. I think the other jurisdictions and people who use another, exchange from abroad, they are in another level of experience. They are real traders, and they are all the time at the desk, like trading. So it's different types of clients, of segments. So I don't really see that's an issue, at least so far. But of course, I mean, the market, if we are talking about market in Brazil, the international players are coming to Brazil since 2018. Remember, like all the international ones, the main Chinese ones, tried to enter in this market, and they did not succeed. Brazil is tough, and to do business, of course, and so that's my view.
So we've talked about a lot of new players, people we've never heard about, working from Puerto Rico, and new names. But Nicolas, you're from BTG. It's a big, traditional and old bank. And so it's a question for both of you, Nicolas and John. Are the big banks and large hedge funds that have been around forever trading crypto, are they starting to do this? Can they give us a little bit of confidence in the...
I believe most of the major banks are starting to look at crypto not only for trading operations and collecting revenue with their proprietary desks operations, but they are also trying to understand the technology and how can they apply the technology to the capital markets structure. So BTG, given the example Nicolas gave me, in 2019 we made something called a security token offering, that is taking a traditional security offering, just like an IPO, and make it happen within the blockchain space. So we took a smart contract, we programmed something called a token. Token is a representation of value that resides within the blockchain. And we pegged it with traditional real estate investments. So it was the first bank worldwide to create a security token backed by real estate, distressed real estate assets located in the cities of São Paulo and Rio de Janeiro. And we made the whole process. Now we are in the last phase that we are disinvesting. And it was much more efficient, much more transparent, and in a sense, it is a better system for financial applications. Not only for financial applications, but to any applications that needs a public registry. And then now BTG is also creating its own crypto trading platform that is called Mint, that is going to be released next week. And you can expect every source of digital assets being traded there, not only cryptocurrencies, but also these types of innovations that we are seeing happening in the market. So you have credit tokens, you have debt tokens, you have DeFi funds that can trade as tokens as well. So it is a new type of asset that you can explore, a new type of technology that you can use to make the traditional offerings much more efficient.
We are seeing the largest managers set up trading teams for crypto. So some of the largest hedge funds that you might read about in the paper that trade equities or other liquid assets are also hiring talent to trade crypto assets, because one thing we know about hedge fund managers is if they can somehow turn a profit, they'll trade anything they can to make a profit. So we're seeing that for sure. We're seeing obviously dedicated crypto fund managers. We're seeing the tokenization. We're definitely seeing that. One of my favorite tokens is offered by a firm called Wave. They have a bourbon token. What I didn't know, I didn't understand about the bourbon technology and how you make it. If you're a bourbon manufacturer, you make the bourbon and you stick it in a barrel and then it sits out in the garage for a long time. Even the biggest bourbon manufacturers in the United States don't have the money to make all of that bourbon and let it sit for 5 or 10 years. So what do? They do like a repo transaction. They sell the barrel of whiskey unaged, and then they agree that in a certain number of years from now, they'll buy it back at a slightly higher price. And the person who does that obviously does it for the return. One of the firms, Wave Financial, went out and bought 100% of the bourbon production from one of the mills, and it bought 50,000 barrels of whiskey and tokenized it. So you can go buy a bourbon token, and it's going to go up in value as the bourbon in the barrels goes up in value. And at some point in the future, you can trade your bourbon token in and get some of the bourbon. I thought that was brilliant because I enjoy bourbon. But there you're going to see tokenization. We're seeing real estate transactions. So if I wanted to buy a very big, expensive building in downtown Sao Paulo, I would probably have to go to I'd have to go to BTG and one or two of the other largest banks and say, I need $1 billion, please, to buy this building. I'm limited to 2 or 3 financial institutions, perhaps, maybe 4 or 5. But if I tokenize the building and say, I'm going to turn it into 100,000 $10,000 tokens, I can raise my money. And now I've brought that $10,000 ownership level down to the retail level. That now a person can say, I own one small part of a building that they could never, ever, ever do before. And you can now finance the purchase of $1 billion asset like a building at the retail level as opposed to at the very highest level. And we're seeing that bringing down expensive things like buying art, we're seeing that come down to a very low level.
Yeah. So we're done with time. So a couple of comments. First, we touched upon regulation and legal, but we are not specialists. So I would go to the panel of our friends at Magalhães and Zettel Advogados at 7:30. They're going to talk about Ativos no Brasil Tendências Regulatórias. So that's going to be very interesting. The second thing is that we had 2 questions about NFT and Web3. You might have heard about those. And of course, we don't have time to talk about them. But you have a table, and Bruno Fegelson, and I'm sorry if I pronounce that not very well, from Lima Fegelson Advogados, is going to talk about on table 4, Web3 and NFT. And I'm being super nice because John is going to be at the table 3. So Bruno is competing with us. So if you go to Bruno's table afterwards, please come to our table as well. Because John is going to be at the table 3 to answer your questions about what we've talked about today. So that's it. 7:30, regulation in Brazil. Table 4, NFT and Web3. And table 3, John, to answer your questions, if you have any. Thank you very much. Obrigado.
Thank you.
Ciao, ciao.